Thank you, Janice. Good afternoon, everyone. On behalf of Forest Services, I will welcome all the participants to the Apar Industries Q2 FY20 earnings conference call. Today on the conference call, we have Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and Mr. V.C. Divakar, CFO of Apar Industries. I will now like to hand over the call to Mr. Desai for his opening remarks. Over to you, sir.
Yeah, thank you. Good afternoon, everyone, and a warm welcome to the Q2 FY20 earnings call of Apar Industries. I will start with an overview of our performance, then cover the industry highlights, and then follow that up with a segmental performance, post which we can open the floor to questions. So during the past quarter, we have seen multiple challenges that we've had to face, led by lower domestic demand in our various business segments. This has arisen from a very heavy and extended monsoon that has slowed down project execution. There also continues to be an extreme credit tightness, which has been exacerbated by delayed government payments. And there is a slowdown in various key sectors that we service, including the automotive segment. Coupled with the fact that there has been no other major stimulus or specific policy announcements that the government has made, as Uday 2.0 is still in the process of being evolved, this has led to fairly difficult market conditions, which is reflecting in our results. In Q2 FY20, consolidated revenue came in at 1,830 crores, which is 3% lower than year-on-year, largely due to a decline in the domestic revenues. With the slowdown in the domestic business, the company has increased focus on exports, and export revenues is actually up. EBITDA post forex adjustment came in at 109 crores in Q2 FY20 compared to 110 crores in Q2 FY19. The EBITDA margin improved to 6% from 5.8%, and profit after tax came in at 34 crores, which is up 18% year-on-year, largely owing to a tax benefit that we have accrued in this quarter. I will now cover a few highlights in the T&D sector as such. So transmission and distribution orders of approximately 13,000 crores are announced by key companies in the second quarter of FY20, which is just marginally lower than the previous quarter. Power Grid has acquired 3 ISPS transmission projects. Adani Transmission has received 2 in the quarter, and Sterlite Power has won another 2 transmission lines. These should eventually percolate into new transmission line orders. However, both Adani and Sterlite Grid are still in the process of financial closure, and the order from these players are taking a lot longer than what had been initially anticipated as a result of this. About 5,300 kilometers of AC transmission lines and 28,000 MVA of AC substation transformation capacity has been physically added in the first half of FY20. The government is working on reforms and expects to launch this Uday 2.0 shortly, that is in the next few months. A new tariff policy that includes penalty for delay by DISCOMs has already gone to the cabinet for approval. The government is considering extending special loans to state power distribution companies to help clear the rising dues to the power generators and constituents in that segment. Other steps have been taken as requirements of LCs by DISCOMs has already been legislated. The government has also announced fiscal stimulus, including a corporate tax reduction to boost the economic growth. A recent research report from the Freedonia Group has predicted that the demand for electric power transmission and distribution equipment in India is forecast to grow at approximately 8.2% year-on-year to hit 15.8 billion in the year 2023. Government is fully committed to the railway electrification. By 2023, the Indian Railways aims to be the world's first railway of its size to be 100% electrified. In FY19, about 5,200 railway kilometers were electrified. The largest issue that we face today is really the delay in payments largely attributed to the various government agencies. And this is in the backdrop of pretty tight credit environment and conditions coming through from the banks, where even growing companies are having trouble getting their limits with the banks extended. So cash flow is what is limiting business, and delayed payments is also consequently resulting in an effect on interest costs and other banking related costs. I'll now turn over to more specific details on each of the segments and their performance. So our conductor business posted a revenue of about 896 crores in the second quarter FY20 compared to 899 crores in second quarter FY19. Strong growth in exports helped counter the decline in revenues in the domestic market. Volumes increased 8% year on year to reach 43,448 metric tons. The EBITDA per metric ton post forex adjustment, however, fell to 7,789 rupees per metric ton, mainly due to lower margin conventional conductor orders, and also there were significant delays in dispatches due to customers' tight financial position. There are some more profitable orders that remain in inventory at the end of the quarter, which should be getting executed in Q3. So this has also sort of adversely affected the specific reporting that falls in the Q2 bucket. The share of new and higher value business was 37% compared to 28% in Q2 FY19. This has included 22% revenue contribution coming from copper conductors for railways compared to 17% a year earlier, and 15% coming from high efficiency conductors compared to 11% in Q2 FY19. Order book at the end of September 2019 stood at 2,621 crores, which is comparable to 2,696 crores from a year ago. However, this includes about 180 crores from the railways for copper conductors and 520 crores of high efficiency conductor orders. New order intake came in at 881 crores, which is about 17% lower than what it was in the previous period, largely from the domestic inflows having reduced. In the first half of FY20, conductor revenue came in at 1,918 crores, which is 25% up year on year. Volumes were up 17% to 85,250 metric tons. EBITDA per ton post forex adjustment came in at 9,921 rupees per metric ton, which is 13% lower than the first half of last year. Having said that, in the second half, we expect much better execution of high efficiency conductors and also OPGW. Railway copper conductor dispatches are expected to slow down due to a stock accumulation that the railways has in their various stores. Execution is actually running much behind the schedule that the railways had predicted and had purchased conductors for. So as a consequence, you will see a slowdown in Q3 on account of that. Also, the copper transport conductor business has been ramping up much slower than we had anticipated, which is largely driven by the problems that the transformer industry is facing in these times. Turning to the specialty oils business, revenue reached 571 crores in Q2 FY20, which is 9% lower than the previous period, largely due to domestic demand, which has been lower across multiple segments that include automotive industry, general industrial lubrication, retail, and even FMCG, besides transformer oil being lower from the power utilities, largely driven by the payment-related issues. Payment to transformer OEMs remains significantly backlogged from the government. Volume came in at 98,156 KL, which is down 6% compared to the previous year. The Hamria plant capacity utilization has increased to over 65% in Q2 FY20, which was at 61% a year ago. The auto lubes and industrial business contributed 23% to the revenues. EBITDA per KL after forex adjustment was 117% higher than in the same period previous year. We expect a relatively stable rupee and relatively stable base oil prices for Q3 and the rest of the year leading into Q4. In the first half of FY20, the oil revenues reached 1,191 crores, which is down 1% compared to the previous year. The volumes, however, are 3% higher than the previous year, and it closed at 204,510 KL. The EBITDA per KL is higher by 57% compared to the first half of last year at 3,398 rupees per KL. In the second half of FY20, demand generally is still expected to be subdued unless the credit situation improves from the government standpoint, and there is some revival in the automotive segment. Turning to the cable business, there the revenues declined by 16% year on year to 369 crores. Financial challenges continue in the telecom sector, and no new investments are in sight either from the government's MTNL/BSNL or the private telecom players. Additionally, there was lower demand from the windmill, solar and EPC segments that has impacted performance. The addition of solar power is about 42% lower than what it was in the previous period. The railway segment has also been slow, as I mentioned earlier in the conductor section, due to the high inventory, and that has affected the offtake of cables that are going even into locomotives and into the passenger bogies. Power cables saw an increased demand from exports, and in the domestic market we've increased sale of copper cables. So the EBITDA, however, was sustained at 11.2% despite lower revenues. Once again here, several profitable cable orders were either in inventory, finished goods at the end of the period, or in transit, which did not allow us to book it in Q2, but these will accrue in Q3. In the first half FY20, the cable business reported a flattish revenue of 263 crores. EBITDA increased 18% to 93 crores, and the EBITDA margin post forex adjustment improved to 12.2% from 10.5% in the first half. We expect to close FY20 at a revenue number which is close to the FY19 number in the absence of any strong catalyst to revive the telecom and the renewables demand. Execution of new solar projects is almost down 42%, as I mentioned a little earlier. So in summary, we are currently in the midst of a fairly challenging market, which can change only post the government actually clearing old dues and announcing new projects. Long-term demand drivers still remain strong, and we are well positioned to monetize the upcoming opportunities. However, the next few months continues to remain a little bit uncertain, because depending on the financial commitments that customers are able to make, our deliveries to them will be dictated. So with this, I come to the end of my comments. I'd like to thank all of you for joining our call, and I would like to open the floor to questions.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Pratiksha Tare from Equitas. Please go ahead. Pratiksha, you may please go ahead with your question.
Yeah, good afternoon, sir. So my first question was about the conductor segment. So, in earlier calls, we've mentioned that as the contribution of HEC and, copper conductors goes up, the margins will improve. But this quarter, we've seen that, though the contribution has gone up, the margins have not seen a significant rise. So could you just elaborate about what were the, what were the reasons for this margin?
We have mentioned in the opening remarks also, and as well in our investor update also. See, the conventional conductor orders are having different margins. So the orders which got executed during this period, they were having very low margins. And certain high margin, close to about, I will say around 120 crores, high margin conventional conductors could not be dispatched because the customers had not made financial arrangements. So we made those conductors and those conductors remained in stock. When it is in stock, then we value those stock at the cost only. So that is the reason actually. Otherwise your contention is correct actually. As the percentage of high efficiency conductor increases, normally the EBITDA margin should improve. In the last call also we had said that time the EBITDA margin was higher because the more profitable orders had gone actually. So the orders which get executed during the quarter, we are not in control of that actually. It all depends upon the customer's requirement and the financial arrangements being made by the customer.
Okay. And with regards to copper conductors, what kind of volumes do we expect to do for FY20?
So, it's a little tricky at this stage to, be able to lay a finger on the exact execution, because for the last 2 months, the railways have suspended taking deliveries of pretty much any conductors and cables, given the stocking up that they have in their stores. So there's no word really out in terms of exactly when they will start lifting the products. So it's a little tricky to be able to put the exact number in terms of what it would be in this period.
Our best guess right now is that as the monsoon is got over for most parts of India, some of the stock will get depleted, and then they will probably start lifting again, and the EPC work which had come to a standstill because of the monsoon, that work will again resume. So, but again, we don't have an exact number to give you right now, but we hope that in the whole financial year, we will sort of have roughly about 15,000 tons.
Okay, 15,000 tons.
Yeah.
Okay. And my next question is on the oil segment. So, you mentioned about the slowdown in the application industries. So, for FY20, do we expect to do, similar volumes as we did in FY19? I think we did about 4.29 lakh KL in FY19. So, we expect to do something similar, or do we expect on a year-on-year basis some degrowth? And on realization front as well, would we be able to match FY19 because H1 has been slightly lower than FY19 realization?
So, let me answer it in two parts. In terms of the demand that's expected for the year, the real difference is coming really from the transformer oil domestic market and from the industrial oil segment, so on the transformer oil domestic market, it's fundamentally dictated by the amount of cash flow that's available in the industry. If you see, a lot of the transformer OEMs are actually holding fairly good order books, but the execution is not happening in the absence of receipt of payments. So, where I hesitate to give this number is that as soon as cash flow starts coming in, the whole cycle will start. And, call-ups will start, for transformer oil to go in along with the delivery of transformers. But that particular, laying an exact number, just like in the case of the railways, because of this current uncertainty, it's a little bit difficult. In terms of the second portion, which is the realization of, there's one realization of value per liter and the other one per KL, and the other one is the EBITDA. So our sense is that the EBITDA per KL will be as much as the previous year, if not marginally higher. Because we are seeing relatively benign conditions in terms of base oil, as well as, the rupee seems to be also within a certain band. There's also expectation that, some of the automotive demand will start picking up in the tractor and commercial segment, as we end this year. So if those things hold good, our sense is that EBITDA per KL should be in the same range as last year, or maybe marginally better than that. But the volumes are a little tricky to be able to give an exact number on.
But in terms of realization, so we did about 58,000 per KL this first half. You expect it to be similar, or do we think we'll be able to do upwards of 61?
Realization will be driven by oil prices. Tomorrow, if the oil prices are lower, the realization will be lower. If the oil prices are higher, realization will be higher.
So our focus is really on the EBITDA per KL, which we believe that in the second half, meaning this financial year, we should be pretty much in line with the previous financial year.
Fair enough. Okay, and my last question, right now, what would be our debt, and if you could give the breakup with LIBOR linked and domestic debt, short-term debt, and also interest cost that we have incurred.
Our debt is about 218 crores. Out of that, about 72 crores is short-term and balance is long-term. And there is about 2,000 crores of LC liabilities are there, which are also attracting interest. Out of that, about 1,250 is attracting LIBOR base, and balance is on the local rate actually.
Can you just give me the number again? 218 crores and the breakup of that?
218. Breakup is 72 crores short term and balance is long term.
Okay.
146 is long term. And 2,000 crores LC liabilities. Out of that, 1,250 is LIBOR based and balance is at domestic rate.
Domestic rate. Okay. Thank you.
Thank you. I would like to remind participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. We take the next question from the line of Gaurav Machiwar from Systematic Shares. Please go ahead.
Good afternoon, sir. I would like to know about the number on Power Grid CapEx and their guidance. How much the CapEx has been executed in the last quarter?
If your question is generally about Power Grid, that number we don't have offhand. But
they have reduced their capex from 25,000 to 15,000. That is what
for the year.
For the year. And capex already done. 1 minute, I have that number. 909 crore done in Q1 FY20. We are not having Q2 number. I think Power Grid also they are having the today's meeting actually. This call, investor call.
So 15,000 crores is the targeted capex that they had announced, and 2,900, say 3,000 crores has been executed in Q1.
Correct.
Okay.
And they have received 3 lines, and so the ordering of those lines and the schedule of that has to still be committed.
Okay, fine, sir. Thanks.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, please press star then 1. Next question is from the line of Sachin Shah from MK Investment. Please go ahead.
Yeah, good afternoon, sir. Thank you for this opportunity. So, I just wanted to understand that for almost now 2 quarters, I think the visibility of the overall business seems to be not very good. Or probably we don't have too much of visibility, let me put it that way. Just wanted to understand on a broader scale of things, how do you think this will actually take up shape in the next 12 to 18 months if somebody has to take a view, and what's your sense in terms of, because it's been almost a few quarters that we are going through this dilly-dally, 2 step backward, 1 step forward, 2 step backward kind of a thing. So overall, with your experience of so many years in the industry and and the way the things are at the ground level, in terms of the new order inflow, how do you see things?
So, if you actually go to see, the slowdown that we've seen has actually come up only at the end of Q1. So, if you see the Q1 numbers, they were quite robust in terms of, volume as well as in terms of, profitability. It's really led by, and it's a little inexplicable to us why the government is still so much backlogged on payments, even after so many months have passed by. Finance Minister has made, several statements and announcements that they are being cleared. But physically the money hasn't come to the participants in the industry. So even though we are holding order books and, and our products are really building blocks that go into transmission networks, distribution networks, transformers, the cables go into, various industries. So if you see, for example, solar is down 42%. If you see the railways, it was very strong, and last 2 months they've, just completely stopped taking delivery. So these are, reactions which are coming in that are something that is not easily predictable.
Right.
So even though we are all holding order books, the entire industry is holding order books. It's not that there is no order book available in the industry. It's not that there isn't business that's out there in the industry. It's just that the timing of this is so uncertain. You have a customer who's pushing you to give you fast delivery, and then after the product is made, there's a problem of, opening LCs and financial arrangements.
Right.
So, this uncertainty, our sense is that it will still take a few more months for it to get settled. I'd love to put a exact date on it, but I think it's a bit too tricky to say.
So fair enough. So what you're saying is that as far as demand is concerned, it's all set in place. It's now just a question of cash flow coming in and moving around the system, right?
Exactly. The cash flow has just jammed everything. If you go to, for example, you take transformer OEMs, we've seen a big decline in the domestic sale of transformer oil. It's largely being limited from, from being able to receive money from transformer OEMs, and they in turn are waiting for monies to be received from various companies. Like, for example, if you take the DISCOM's accumulated dues,
right,
at the end of June, that itself was 72,000 crores.
Right.
Of which 53,000 crores is, overdue. Now the government is pushing them to open letters of credit, right, which mean that there will be some diversion of funds, to honor some of these LCs. So as a consequence, the cash flow that's coming into the industry has really got affected badly. So the recent EMA AGM, some of the leadership in EMA, which is the apex electrical body, was saying that about 35,000 crores is the overdue to the industry as such. When this AGM took place, it was in the month of September. Post that, monies have come in, but it's a trickle. It's not like a large amount coming in. Right. On the other hand, if you see the order books which are there, our conductor order book is at 2,600 crores. Right. If you see, the projections which are there from the railways, or the projections which are there for addition of solar power, wind power is actually getting awarded again. Okay. The numbers look all good, but we don't know when it will get executed as such.
Right. And for us, the new order inflow?
So there is an order inflow that's coming in, but I think it will pick up steam once financial closures happen. Like as I mentioned earlier in the opening remarks, you've had 6 transmission lines, 13,000 crores which were awarded in the last quarter, but the downstream orders have still not come through. If you look specifically at the conductor orders received by us in the last quarter, it's 881 crores.
Okay.
Of which 530 crores is from exports, and 340 crores is from domestic, or 350 crores is from domestic.
Okay, right. And so the other thing is, now that we have not seen much of volatility in the crude oil, right? And earlier we used to have a margin of EBITDA per liter of closer to about 4.5-5 rupees when the market, when it used to be a stable environment both on the crude and the currency side. Do we expect to get back to that level at some point in time? or the overall market is now so much disrupted in terms of pricing or whatever that now 3.5, 4 is a more realistic thing?
So we should get back to that level when demand starts picking up.
Okay.
Currently, what's happening is that people who are solvent and are ready to open letters of credit or confirmed instruments of payment,
right.
Everyone wants to sell to those customers. So
right.
the competitive intensity of pricing to those customers is very high. Right. Customers who are relatively slow in terms of being able to pay, etc., they are on credit block. So there is a bit of a disruption, but our clear sense is that when these conditions are stable like they are today, it's a matter of time before which you'll start seeing the margins coming back to those levels.
Fair enough. And on the cable side, do you still believe that the wind and the solar will actually come back in the ways that we've seen in the last 1 or 2 years?
So there are
1 or 2 quarters plus minus a different story, but generally as a trend.
Discussions that have happened with SECI and NTPC and a few of these other people, because most of it has been in the nature of technical discussions. But along with that, you get some idea in terms of the announcements that they will make on the volumes. Right. So the volume numbers are staggering in terms of what they are talking about, of implementation. But there is a whole lot of execution problem that's there because of, policy uncertainty. There's no clarity in terms of, the exact duties on solar panels coming in. Right. They want to now create 2 classes of tenders, one which allows you to have imported panels and one which has a larger indigenous content. So a few of these things, they are not yet stabilized, because of which some of these contracts which are planned have not either been tendered or being finalized. There are also some of these tariff glitches which are there, where suddenly contracts have been, unilaterally cancelled, etc. So that has resulted in, some more disruption taking place. But our sense is that this policy uncertainty in the next few months will get sorted out.
Okay.
So the solar will take off. They have decoupled solar and wind because the development of wind is along a different corridor. Right. And there have been some improvements in terms of the wind tariff and even the solar tariff which they are willing to pay in today's context.
Right.
So we are seeing that some companies like Siemens Gamesa, etc., are giving better projections for the second half of the year.
Right. So if I have to sum it up, will it be fair to say that Q3 will be little better than Q2 because some spillover of orders of Q2 came into Q3, and Q4 could be even better because of certain challenges in terms of whether cash flow or policy and all of that might just get sorted out in the next 1 or 2 months? Will that be a fair assumption?
Yeah, our sense is that Q3 will be better than Q2. And as I said, for 2 reasons. One is something that's already there in the bag, which is that, due to the monsoons and due to the financial tightness which was there, we have a fair amount of conductors as well as cables, both of which are reasonably profitable sitting in the inventory, which will go out in Q3.
Right.
Secondly, there were genuine delays that happened because of a very brutal monsoon.
Right.
And even though it's rained quite heavily today in Mumbai, I think we should see the back of it for most of this, for the remaining part of this quarter. Right. So as Chaitanya mentioned earlier, project execution also will start picking up.
Right.
And once that happens, then generally most of the Indian companies are quite flexible in terms of working longer hours and trying to make up, for lost time.
Right.
So our sense is that Q3 will be better than Q2, and then hopefully Q4 will be better than Q3. With project execution happening plus some of these policy issues getting sorted out. Because I think the government is at the moment on borrowed time if they want to even come anywhere close to the projections that they have.
Fair point. And any sense where will these cash flows come from?
That I think you've got to ask the finance minister. She seems very confident that the dues will be paid.
Right. I'm jokes apart, but just a sense that are you seeing any catalyst in the system which will probably help this thing, this logjam to get unlocked? Is there something that we should keep an eye on?
We are not seeing any catalyst. On the transmission side, The good thing is that you've got, Power Grid that has, 3 lines which are there. And they are financially solvent. They should not have any problems in bringing about financial closure. Right. Similarly, Adani has, a pipeline of making arrangements for their finances. Right. And so some of these lines should continue. Sterlite Grid, we are not exactly sure where they stand on their financial closure scene. The railways piece has been delayed simply because of, the speed of execution. Right. So, in fact, they have new tenders which are out there, which have been opened. Okay. But they're not awarding those tenders until, there's more movement taking place on the older tenders. So, I think the railway side will start picking up execution, in Q3 and definitely in Q4. So, generally, it's a little bit brighter, but the cash flow side is something that's not very clear to us yet. The railways, of course, they are well funded. So we don't have a problem of collection from the Indian railway side.
Right. Yeah. Just one last question if I can squeeze in. If you can just elaborate a bit on the finance cost. It's always been a bit confusing, this thing, because 124 crores for just the 6 months. Can you give us some sense how should we look at it on a full year basis and how do we see things moving?
As far as the finance cost is concerned, see, basically we have to remove the open period forex. So for this quarter, there was an open period forex of about 15 crores, which we are, if you see our investor update actually, we are giving EBITDA before adjustment of open period forex and after adjustment of open period forex. So difference between these two numbers, if you see the EBITDA numbers, we are capturing close to about 15 crores in this quarter. Okay. In this quarter itself. So that is why, although the number you will see that number is about 67 crore is the number for the quarter finance cost. Out of that, 1 crore is this 1 crore interest income is there, which statutorily we are required to show in other income. But we should be adjusting that for if you want to see the position. So So you have to remove that actually, and after that if you remove 15 actually, the finance cost will come to about 50 finance charges. Correct? So that level we should be able to see. Only thing what has happened is that actually we could have done it in this same finance cost, we could have done a turnover of close to about 250 crores, which we 250 crores more. Right. Which we missed out actually. As we said that 120 crores of conventional conductors, about 100 crores of railway conductors, and about 30 crores of cables which were in transit. So as far as cables is concerned, the cables were in transit actually, and this could not be accounted because it was a CIP contract, wherein unless the material reaches the project site, not DDP actually, CIP actually. And the conventional conductors also, we have already made those conductors actually. Those conductors are sitting in stock and we could not dispatch. As far as railway conductors are that, we had not manufactured the railway conductor, but we had taken the raw material. So all the, if you say so, the financing cost of this entire 250 crores is there in this finance charges. Okay. So we should get the benefit of that in the Q3 then. Yes, definitely. Because the 250 crores will not have any interest. Yes, correct. Okay, so on a 9-month basis, it should even out more or less. Yes.
Yeah, I think if the second quarter has had a really bad, a very difficult environment. Right. So I think a better judgment would be looking at a YTD 9 months. Right. Which will then hopefully give a truer picture to the current situation.
And otherwise also, normally in our case actually, the last 2 quarters are much better than, if you see last year also, we were at this level only, PBT level, same PBT level, but ultimately we reached close to about 236 or something.
No, fair enough. Sir, just one last thing, that this year you've given us a fair good sense of how things can move. If I take a little longer view, say FY21, FY22, FY23, these 2-3 years, how do you really see things shaping up? If you can just walk us through each of these segments in next 2-3 years.
So we'll start off with the conductor segment. Yeah. So there, if you see some of the value drivers which we have, which is really the high efficiency conductors, the optical, ground wire.
Right.
And then, the copper conductors for the railways, where they need to complete their plan. And then, also the copper transpose conductors, which we are planning to do. All of those should actually end up doing better than what, you've seen in the last few months. Already the high efficiency conductor business has started picking up, after the lull that was there last year. As was mentioned earlier, it contributed 15%. The profitability of that has got a little bit drowned in the problems with the conventional conductors, but the trend is clearly upward. Okay. This OPGW also, there are a number of contracts which are likely to be tendered over the next couple of years, because now every earth wire is actually carrying a fiber optic core, given the value of data that's there today.
Okay.
The copper conductor plan is a very defined plan by the Indian Railways, and they've given a clear announcement that they want to complete it by 2023. So if that happens, then the pace at which copper conductors will be supplied will, continue.
Right.
And then on the Indian Railway front, if you go in and look at the Railways plan of adding locomotives as well as passenger bogies, a lot of the current passenger coaches are getting rewired to be more relevant to what is required today. So, we are quite happy with the business segments that we are in.
Right.
And the demand for that is not going away anywhere. It's pretty much there. If you look at the specialty oil side.
So just 1 second on this cable side. How do you see the competitive scenario? Are we still in a very good shape in terms of our value-added products still remain to be value-added, or are they becoming now more commoditized? Are you seeing competition?
So there is increased competition coming on electron beam products, because there are a number of other players who have now added electron beams. But the market size of these cables is also growing.
Right.
As they're getting more and more adopted. So
I'm saying on the conductor side. Are we seeing competition in terms of...
So there is competition in terms of all the segments. It's not that they are without competition.
Right. But do we believe that our margins...
Intensity of competition in these segments is much lower than in the case of conventional conductors. Right. And we don't see any very large players coming in to disrupt the market overnight in any of these 5 segments that I just mentioned.
Right. And this OPGW, it will be largely telecom companies who are our customers?
No, there will be transmission companies. So there is an earth wire that's connecting every 2 towers.
Okay.
And so that earth wire actually will, in this OPGW, carries a fiber optic core. So that data can be transmitted. So the largest OPGW installations in the country are today with Power Grid and the Indian Railways.
But they would do it for telecom companies?
Sorry, not the railways, the Power Grid.
But Power Grid would do it for whom? For telecom companies, finally.
They charge, they have a charge for transmission of data over their network.
Okay, so they rent it out. Okay, got it. Okay, sir. You were saying something on the transformer oil side, sir.
Yeah, so on the transformer oil side, it's a direct proportion to the amount of electrification work that goes in, both on the transmission side and the distribution side. And if, these electric vehicles and things need to come up over the next few years, then the demand for particularly transformers and cables is going to really increase dramatically.
But that is a really long shot now. That is at least 5-10 years away. I'm saying next
the other thing which is there is that more non-conventional energy that comes up, which is between solar and wind, the networks require more amount of transformers to go in, and it requires more unique evacuation systems. So the demand for mid-range transformers for mid-size conductors also will proportionately go up with the amount of solar installations. Of course, there is a fair amount of cables that go into the installation also.
Right.
So non-conventional energy is actually a big boost in terms of demand for all 3 of our product segments.
Okay. So you're fairly optimistic about things moving in the right direction.
We feel that the demand for the products will continue to remain. It's
Right.
We are only hoping that the choppiness of his execution gets a bit evened out.
Okay. Perfect. Perfect. Thank you so much, sir. Really appreciate all the answers.
Okay, thank you.
Thank you. We take the next question from the line of Pratik Kothari from Unique Asset Management. Please go ahead.
Hi, good afternoon, sir, and thank you for the opportunity.
Yes, good afternoon.
Sir, regarding this 200 crores of high-value conductor which we mentioned, which we couldn't ship it from our, it's lying in our inventory, has it already been shipped in October?
About 120 crores I said actually. 120 crores of the conventional conductors we could not ship actually in September. It is still not shipped actually because the financial arrangements have not been made. Customer has not made the financial arrangement. They have not opened the letters of credit. So we are sitting on that inventory. That is how the finance cost increases. And as far as the copper conductor is concerned, another 100 crore copper conductor, that we had not made the copper conductors. So we are trying to see actually, and we had disposed of some copper also. As it is. Because we got the intimation from the railways that in the Q3 will get consumed certainly
On the cable side.
On the cable side.
Yeah.
But
and the cable deliveries, they've already in transit, so they've already now happened. So that recognition of that 30 odd crores will definitely come. It has already come into October.
Okay. Fine. And so we said about, I think, 1.92% PAT margin in the first half. And I think we had guided 3% for the full year. So where do we stand in terms of that?
Normally we said that actually the second half is always better. If you see, we are more or less line with the first half of last year. First half of last year was about 87 crore PBT, and this time we are about 85 crore PBT, something around that. But second half normally is better for our company actually.
So you mean in terms of PAT margin or PBT margin will be...
In terms of EBITDA margins actually, and then accordingly the PBT margins.
So we'll be in lines with FY19?
Yes, we'll be in line.
Okay. And so just to understand, I think this is a repetition, but between quarter 1 and quarter 2, in terms of conductors are high value, is the share of high value is almost the same, and in oils also high value is almost the same. But the EBITDA per ton or EBITDA per liter has gone down significantly. So if you can, maybe it's a repetition, but if you can just throw some more light, what happened?
As I said earlier, actually, it is driven by different type of conductors which are going. So the conventional conductors which went in quarter 2 actually, they were having very low margin as compared to the conventional conductors which have gone in the quarter 1 actually. And some conventional conductors which were having better margins, they could not go actually, as I told you actually, that 120 crores. So see, conventional conductor, there are different orders are there. Every order has got different margins. And which order will get executed in which quarter, that is not in our control. It all depends upon the requirements of the customer and the financial arrangement made by the customer.
So, the bottom line is that Q2 is a little bit difficult to, it's difficult to analyze because of all these various other issues which were there. We're probably better off looking at, a YTD number that comes, for the 3 quarters. That will start ironing out some of the kinks.
Yeah, mainly coming from, we are not seeing any margin pressure aspect on copper conductors or APC conductors.
So that hasn't, meaning whatever margins were there in Q1, they continue to be there. So the thesis on those 5 products haven't changed. It's really between happening on either execution or on the conventional copper, aluminum conductor. So let's see what happens in Q3 and then, take a stock on a YTD 9-month basis.
Fair enough. And in terms of oil,
Pardon me, we lost you. The line wasn't clear.
Mr. Kothari, I'm so sorry to interrupt, but your audio is not very clear.
Yeah, is it better now?
Yes.
Yeah, my question was on oils also, sir. Again, high value oil concentrate, the share still being 25% between quarter 1 and 2, but EBITDA has shifted substantially. So if you can throw some light on that also.
So, well, it's actually just driven by, as I said, competitive intensity, which is there, which has been there in particularly the second quarter, where, because of the tight financial situation, the customers that were solvent, the competitive intensity with them is extremely high. So, however, segments like some of these automotive, including tractors and things, should start picking up in Q3 and particularly in Q4. So you'll start seeing, better movement taking place on that. So our sense is that profitability will be better in the second half in the specialty oil segment compared to the first half.
Mm-hmm. Okay, sure. Thank you and all the best.
All right.
Thank you. Next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir.
Yeah, good afternoon.
Thanks for the opportunity. So my question is regarding, you said Uday 2.0 government is likely to roll out. So what kind of benefit, we are expecting from the same? Or is there any kind of a benefit we derived, during the launch of Uday, starting of initial Uday, which launched maybe a few years back?
So what happened in the first, in Uday was that, there were certain stimulus that, amounts of money that the government spent to accelerate electrification, particularly in the rural areas. So they are in the process of trying to put something together for the coming few years. But that has not been announced, and there are some prerequisites which are coming with that, which include DISCOMs having to make more disciplined payments, a penalty to come in, if tariffs aren't, being charged at a certain level, etc. So that the scheme is not out yet. It's still in a work in progress form.
Okay. And so what was the quantum, expenditure done in Uday 1.0?
Basically, they are not spent on Uday. There was Deen Dayal Upadhyaya scheme and Saubhagya scheme and all those schemes were given. Whoever signed the MOU, they were given benefit of this scheme. What basically happened in Uday, the original Uday, was that financial restructuring happened, because of which the interest cost went down overall.
And so there was, if you take an outlay, it was in the region of about 40,000 crores that was directly put into the Saubhagya scheme and the IPDS.
Okay.
And so what they are planning to do in the second version of a stimulus is not exactly outlined yet.
And second question, taking a long-term view, let's say, next 2 to 3 years, sir, in terms of revenue mix, the cable is the high margin, business. So where do you see this mix changing in next 2 to 3 years?
Well, within the cable business, we see that at least in the next 2-3 years, demand will continue to remain fairly strong from the railways and defense. These two segments, will continue. Power cables is where, the competitive intensity is high. Optical fiber, we are not at all optimistic, given the current state of, the telecom companies as such. So bottom line is that, this year we will see a revenue which is similar to what we did last year on the cable side, but the profitability will be a bit higher. We are already running first half at about 11.2% EBITDA versus 12.2 versus 10.5, which was in the previous year. So this we continue to see a similar sort of mix of product, going forward over the next 2 to 3 years.
Around 20% range in terms of revenue, and conductor would continue to maintain 50%?
Oh, you're saying mix of our business revenue mix, you're saying, within Apar Industries? So we see the cable business growing at a faster pace than the conductor and the oil segment, because the addressable market itself is very large.
Can that change, and the the margins which we have delivered in 2017 of around 9%, we are again targeting those kind of a margin from current 6%?
So, at this stage it's difficult to comment on, where these margins will reach because, as I said, there's so much of uncertainty right now. But if you ask me the general trend, the cable business will grow at a pace which is faster than the conductor business and the specialty oil division.
So we are witnessing, some kind of a commodity softness. So does it help us to gain, some kind of a margin benefit?
Not really at this stage because, the commodity softness which is there is available to every player that's in the market. And given the current competitive intensity, it's pretty much getting translated into price. So the end customer is benefiting from, getting products at fairly competitive prices.
Okay. And so what will be the overall capacity utilization across the plants?
So in our cable side, we have capacity utilization is around 85% at the moment. Overall, there are a few product categories where it's a little bit higher and a few lower, but overall it's at about 85%. In terms of the conductor side, we are at about I think 88 or 89% based on what we did last quarter. But there we have a very high degree of fungibility between high efficiency conductors and conventional conductors. So our objective would be to get after as much of the high efficiency business as possible. And if we run out of capacity, then to just reduce the amount of conventional products. And on the oil side, we have adequate capacity to meet demand. So we are running, the Hamria plant is running at around 65% capacity. Our domestic plants are running at also somewhere around the 70% range.
And so what would be the capex plan for FY?
Mr. Shah, I'm so sorry to interrupt, but requesting you to please use the handset mode while speaking, sir.
Okay. And so what will be the capex plan for FY20 and for the next year?
FY20 capex plan is close to about 168 crores. Total plan is there.
Okay. And sir, what will be the utilization? I mean, where we are utilizing this?
We are utilizing it across all three businesses. Close to about 35 crores is in oil. Close to about 90 crores is in cables. And close to about 32 crores is in conductor.
So we are increasing the capacity, or is it for maintenance purpose?
Which one? As far as cables is concerned, we are putting E-beams, electronic.
Yeah, the cable capacity is being increased. And even on the specialty oil side, we've actually gone through this in great detail in the last last call. Okay. The capex that's happening on the oil side is to increase blending and packaging capability on automotive and industrial products. In the case of
conductors, it has been also some backward integration for some OPGW product.
And in the case of cables, it's expansion of electron beams and some of the cabling capacity that is required for the flexible elastomeric type products. There is also consolidation of some of our buildings and warehouses and all that, because the multiple plants were there which we inherited from Uniflex. So that consolidation of some of that manufacturing is also taking place. But more importantly is that from the next year, from FY21 onward, you see a significant drop in the capex.
Okay. Understood, sir. Thank you, sir. That's it from my side. Yeah. All the best.
Thank you. Next question is from the line of Maulik Patel from Equirus Securities. Please go ahead.
Hi. Good afternoon, sir.
Yeah, good afternoon.
A few questions. I think we have a sizable debt, including the acceptance, right? And a lot of that debt is related to the working capital, what we have been historically carried on the books. Any plan to taper down that, either in terms of the lowering the capex or any prepayment, something? Because it's been pretty much stagnant since last couple of quarters, if I have to say?
That acceptances which is there, it is driven by the level of business. You have seen that the turnover has also been increasing.
Sure.
Across all the divisions. So as the turnover increases, you require more raw material to be brought in actually. And in that process, these acceptances are there actually. So
out of the total debt, how much is in the long-term debt related to the related to non-working capital debt?
146 crore long-term.
And the remaining is all working capital debt?
Remaining is all working capital debt. See, our sector is stressed. The power sector is stressed. Tomorrow, if I am able to get my payments in 30 and 60 days, actually, I will not require that type of acceptances, no? Then
Sure, I got it. And sir, in terms of the capex, what kind of a capex we are looking for the remaining half year and the next year?
We have done close to about 72 crores, and as our capex plan is about 168 crores, the balance will be done in H2.
Okay. And part of the capex is going into the new e-beam machines which we are procuring.
Yes, sir.
So this is the third e-beam machine which is coming in. Plus there has been additional land and building facilities also that have been built on the cable side. So that, as we need to expand, then, the machines can be, can be installed.
Okay. And what I understand that I think long back when we had in the chat, in China there were more than 200 or 400 e-beam machines at one point of time, right? And in India there were hardly any few e-beam machines. Now what is the scenario currently? And in couple of years back, a lot of Indian players were sending their cables to the China for various kind of process. So what's right now is happening in that sector?
So there has been an increase. There are other players that have now started setting up e-beam machines. All the e-beam machines coming into the country are largely focused around the cable side of the business.
Okay.
So you've had an addition coming in from Polycab side. You've had Leone, which is a German company that's added some e-beam machines. There's Universal Cables that has added one. There's Thermo Cables out of Hyderabad that has added one.
Okay.
So there are about 6-7 new machines that have been added. But then the demand also has started growing, for these cables. So in China, the machines are not only going towards cables. It goes towards, many other segments. Like the auto cables there are all e-beam now. Whereas in India, it's just starting. In fact, we are one of the few people who are now pushing e-beam cables to be used, to increase safety in the wiring of passenger vehicles and commercial vehicles.
Okay.
So it's going into a number of other segments. A lot of e-beams in China are used also for food processing, for sterilizing food.
Okay.
So in India they have an alternate system, but we believe that over a period of time these e-beam systems will work out to be more cost effective.
So in a way that what I understand that there are the new applications of the e-beam which will come, which are already there in the developed world or the China, which are not there in India. But this application probably can be a big growth driver going forward.
Yes, you can actually get into e-beam products which are outside of cables. And Apar already does some amount of service revenue for, so we do irradiation of jointing kits, for example, which are used, for during the EPC work of cables, laying cables. So we have RPG Raychem is, for example, a customer that supplies, that gets their jointing kits beamed by us. So we have about between 4 and 5 crore revenue a year that comes from services on the e-beam side, and this is a business which can theoretically grow, as we add more machines.
Okay, got it. Okay, sir. Thank you. Wish you all the good luck.
Thank you. Next question is from the line of Pratiksha Diktare from Equitas Investment. Please go ahead.
Thank you for the opportunity. Just two bookkeeping questions. This balance sheet, we see some new item called right to use assets of 53 crores. Just wanted to know what that would be. And what we see are ETR to be, effective tax rate to be going forward.
As far as this 53 crores is regarding, you are aware that this new leasing standard has been implemented from 1st of April actually. So wherein whatever items which are there on lease, you need to bring it on the books. So they will be coming in the form of right to use actually, and there will be accordingly there will be a liability will be there. And as against the lease rentals which used to come in the profit and loss account, as against that you will have interest and depreciation. The second question I have not understood. Please, can you elaborate on that actually?
Well, we have, after the new tax regime coming in, what will be the effective tax rate?
Effective tax rate. Our effective tax rate will be closer to that actually, 25.17.
Okay, thank you.
Thank you. A reminder to the participants, if you have a question, please press star then 1. Well, as there are no further questions, I would now like to hand the conference back to the management for closing comments. Over to you all.
I thank all of you for taking out the time to be on our call. And just as a quick summary, Q2 has been a very difficult quarter. We see hopefully Q3 and Q4 having being better with at least climatic conditions being something that's more conducive to project execution, and then look forward to some of these government schemes and cash flows coming through. With that, the visibility should then improve, and maybe as we have our earnings call at the end of Q3, we may have better visibility in terms of being able to predict what the next few quarters would look like. So thank you very much for your time. Goodbye.